Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So it's not exactly news that the housing market has been on fire, starting in 2020 as Americans relocate based on any number of factors, including the pandemic, including work from home and lifestyle changes. Even the Federal Reserve is factoring into the housing market now. Jay Powell and the Fed governors understand the need to rein in one of the biggest drivers of spiking inflation, which is the red-hot U.S. housing market. And the Fed may be succeeding, at least somewhat. There's increasing evidence that the economic shock of higher mortgage rates may be taking some steam out of the housing market. According to Fortune magazine, there was a shift in the housing market at the end of March as interest rates rose to 5%. Now, Fortune also notes that housing inventory bottomed out in mid-March, and there have been 3 consecutive weekly increases on Zillow.com. That's notable. Additionally, Redfin says it's seeing an increase in the number of sellers reducing their prices, along with evidence that demand for second homes is dropping. Okay, but none of that changes the demographic realities that we're facing. College students will need housing as they go back to campus for the college experience, not some online classes. And when they graduate as young professionals, they will need affordable apartments. As they start families, they may want to rent a house rather than jump in as buyers, particularly in expensive metro areas. Meanwhile, their retired parents are looking at communities geared towards them. And their elderly grandparents need some kind of community that may include skilled nursing care or other services for the elderly. Today's guest is an investor in all those housing subsectors. David Auerbach is managing director of Armada ETF Advisors. In this interview, he makes the case for ongoing demand for some very specialized categories within the housing market. And no, we're not going to talk about the typical home builders that you might expect. David is factoring in some demographic changes over the coming years, and he shares specific names from his portfolio that are well positioned to capture strength as those changes unfold. Give a listen to this interview with David Auerbach of Armada ETF Advisors. Okay, so David, you focus on home appreciation as your investment philosophy and what you've developed into an investment product. That seems to be a sweet spot. So just tell me a little bit about how you selected that as an investment thesis and what's that looking like for you right now?
Sure, Kate. Great. Thanks so much for having me today. You know, this is a very unique story, what we're in with the housing market here currently in 2022, in that most homeowners can't buy a house right now. And so we decided to take an approach of what sectors benefit when many people can't achieve that home ownership dream. And so for us, we were able to break that out into 5 sectors, and that covers multifamily, which are the apartments, single family rentals, manufactured housing, student housing, and senior housing. And we'll go into in depth on all of these sectors over the time of the podcast here. But what we tried to approach was, since so many people are being shut out of the housing market based on corporate relocations, property taxes, all these, various factors, what cities have benefited from the relocation and what property types have benefited within those cities? And so we actively have been able to position the portfolio playing these 5 subsectors using that information in our pocket.
Okay, so let's go into that a little bit more, because that is interesting, and that is a thesis I've heard quite a bit. I'm sure we're all familiar with that, right? With the home prices being out of reach for many people. You know, we were talking before I began recording today that I live in Santa Fe, New Mexico, which is just one of these cities, David, where the housing prices have absolutely skyrocketed. And what I'm seeing here is more apartment complexes being built for the first time in many years. I've realized this. So is that the kind of thing that you've been looking at?
Yeah, that's exactly what it is. It doesn't matter if it's Santa Fe, Albuquerque, Dallas, Austin, Raleigh, Nashville, Charlotte, Tampa. All of these markets are seeing huge demand for homes. If you think about some certain cities, like let's say California as an example, where there was a community that had less than 10 homes for sale several weeks ago in a weekend, and they had 1,500 showings for those 10 properties. Well, what happens to those 1,490 folks that are not able to buy those properties? And so, you mentioned the apartments. That plays into our thesis as we're looking at Sunbelt apartments. So some names that, potentially resonate there are like Mid-America Apartment Communities, MAA, Camden Property Trust, CPT, United Dominion based out of Denver, UDR. These are perfect examples of companies that have basically taken those Zillow and Redfin top 50 lists of where are people moving, and that's where they're really planting their flags. Now, granted, Camden's been Sunbelt exposed for many, many years, but as we learned during COVID, with so many people leaving the coastal markets and moving into the Sunbelt, Camden was really in the driver's seat for all of those relocations. Another example is the single-family rentals. People wanting to move out of their parents' basements for the first time because they were stuck, they hated being cooped up during COVID. There's 3 publicly traded companies that are out there that cover the single family rentals. Chances are most people have heard of a company called Invitation Homes that's owned by Blackstone, what used to be owned by Blackstone. The ticker there is INVH. There's American Homes for Rent, AMH. And then the newest entrant is from Canada, but they have a U.S. portfolio dual listed, and that's Tricon Residential, TCN. There was a great 60 Minutes interview that was about, 3 weeks ago. And the lead story was on single family rentals. And they interviewed Tricon's CEO. And he said, look, we have about 200 to 300 homes available for rental per week. We're getting over 10,000 inquiries per week for these homes. So again, back of the envelope, that's like 500 to 1, 500 inquiries per house available. Again, many people are going to be left out of the cold. And so how do you play this when all of these guys, whether it's apartments, single family rentals, manufactured housing, how do these guys basically bring enough supply online to satisfy that demand? It's no secret that we are more, according to Redfin, we are more than 4 million homes in the hole of a shortage to satisfy that demand. And if you look at places like, again, here based in Dallas or Raleigh or Tampa, there is no end in sight for when that demand is going to be satiated. And so therefore, who benefits from that? Well, the apartments, the single family rentals, and the manufactured housing guys.
Yeah, you just alluded to something that I was wondering about as you were speaking, and I want to circle back and do a little deeper dive into some of these stocks because I was pulling up some of the charts while you were speaking there very quickly. But talking about sort of this demand that you don't anticipate will be satiated anytime in the near future, what is kind of the runway for this? Do you have an estimate in terms of how many years that you really see the strongest possible growth in this sector?
I mean, we're hearing reports of potentially 5 to 10 years out for this number to be fixed. Now, does that mean that the Sun Belts are going to stay on fire for the next 5 to 10 years? If I knew the answer to that, I'd be flying out to Santa Fe to pick you up on my G5 and we'd be going out to Fiji this weekend.
Great.
But in all seriousness, what we do know is that, let's take a place like New York or San Francisco. There's only one New York City and there's only one San Francisco. We can't just replicate that here in Dallas, Texas. And so as a result, I've always been a big believer of if you build it, they will come. And there was a reason why they use that expression, they aren't building more land in New York City. And so, yeah, they may have seen that hiccup during COVID of people leaving from the coast and moving in. But what we started to see now on the other side of COVID, hopefully, is that we are seeing that come back towards the coast. People are going back to New York and San Francisco. And so does that mean that everything is back hunky-dory, back to usual, back to pre-19, pre-COVID levels? Not necessarily, but in the same breath, we know that when you have companies like Apple and Google and Tesla and name this company and State Farm and whomever relocating across the country to Texas or to Raleigh or to Charlotte or Nashville or one of these places, that demand isn't going to be letting up anytime soon. Because let's be honest, California isn't about to end its state income tax anytime soon. The gas prices in California are not about to come down anytime soon. And so, companies are trying to do what's best in the interest of their employees as well. Do we want to go to a more tax favorable state where our employees can basically keep more money in their pocket? And that's why you have very tax-friendly states like Texas and Florida, which have attracted so much talent into their backyards.
So it sounds like it's a little bit of a mixed bag geographically. Like you may be seeing some relocation to the coast, but also kind of that Sunbelt play is still very strong, is what I'm hearing.
Correct. And again, like you still use other examples. Like I was just in Chicago a couple of weeks ago, and I don't consider Chicago one of these on-fire markets like Dallas, Raleigh, and everything else. But yet, in every meeting I had, I heard some housing story about trying to buy a house, can't buy a house. We've got 25 offers to sell our house. It really doesn't matter right now where this story is happening. People then bring up this concern of, oh my gosh, they're raising interest rates. Isn't that bad for housing? Isn't that bad from where you sit? And frankly, we're excited about that. And I know that comes across as crass, but from where we sit, we're thinking about the end consumer, the end tenant. So the 24-year-old graduate of college who's working his first job, living in an apartment, either with a buddy or a boyfriend or a girlfriend, doesn't care that the Fed raised interest rates 25 basis points a couple of weeks ago, or is raising it 50 basis points a few weeks from now, or whatever that number is going to be. All that tenant cares about is, I'm paying X per month for my apartment now. I'm going to be paying Y per month next year. The difference of Y minus X equals some amount. And then, the concern is, I'm paying $1,000 a month, and my landlord says instead of it being $1,100 next year, it's going to be $2,000 next year. Is that a problem? Well, it's kind of a double-edged sword. To the renter, yeah, it's probably a problem because your rent just went up double. But in the same breath, think about it from the landlord's perspective. Why is he charging basically double? And granted, that's a very extreme example that we're using here, but follow my logic. Why is that landlord charging double? Chances are there's new inventory that's in the neighborhood that's commanding that price tag or something even higher. Or number two, the guy's already lined up a tenant ready to fill that space who's already willing to pay potentially that $2,000 price tag. So remember, the landlords know the markets better than anybody because they've got all the tenants. They know how much they're getting paid in rent every single month. Historically, the REIT sector in general, residential and everything else, in times of rising inflation and interest rates, the REIT sector has tended to outperform. And so regardless of rising interest rates, what you really need to figure out is who does this impact more? From where we sit, the rising interest rates really affects more the developer, the construction loan, the guy that's going to be planting the shovel on the ground. And by the time that construction is completed, well, guess who's going to be paying that loan back? It's going to be the tenants. And so therefore, that's already going to be, call it baked in the cake or priced into that rent. And so they're basically going to, pass that off to the end tenant when it's all said and done. So for the single family rental guys, it's the same situation. You're a tenant, you're renting, you don't care what interest rates are. That only affects you if you're trying to go out and get a mortgage on a house right now.
Yeah, absolutely. Makes a ton of sense. As a trader or investor, you need timely information to help you make better decisions, and analyst upgrades and downgrades can give you the outlook for the stocks you're watching, coming from the big institutions who are behind 75 to 80% of market movements. For absolutely no cost, MarketBeat will send analyst recommendations right to your inbox daily. You will get a concise summary of analyst upgrades, downgrades, and new coverage, along with relevant news and information for the stocks on your watch list, real-time portfolio monitoring tools, a rundown of the top headlines each day, market calendars, the MarketBeat mobile app, and other research tools. Don't miss out on this. Sign up right now. It's 100% free. You'll find this at marketbeat.com/ratings/newsletter. That's marketbeat.com/ratings/newsletter, and that link will be in the show notes. Let's do this, David. Let's circle back and let's jump back into some of these actual names of the securities that you mentioned. And are all the holdings in your ETF REITs? I'm guessing so by the name, but just wanted...
That's correct.
They are, okay.
We're the only active pure play residential REIT ETF. And I'm glad you asked that question because there are some other residential real estate products on the market. And I will encourage every investor, every person that's listening to this, and we may not be the story that resonates with you, but for anybody that's looking at ETFs, what we want to try to educate all investors is, and I quote Todd Rosenbluth, who is now with a firm called ETF Trends. He used to be at CFRA Research, but Todd has always been very pump up your chest, pound down your chest about know what's under the hood. You need to know what's driving the engine of your car. And so for some of these residential real estate products that are out there, there could be, and I'm just throwing a variety of examples out there, self-storage REITs, home builders, mortgage lending and financing, Home Depot, Lowe's, restoration hardware, home improvement type stories, hotels. The answer is it depends on what is defined as residential. So we took a different approach of, is it residential? Is it a REIT? Okay, it's probably in the portfolio. And that's very specific because, again, we're the only active product that's out there, and we're trying to avoid what I call the noise that is like self-storage REITs, which are a great complement to residential, but it is not residential. Or Home Depot and Lowe's, home builders, mortgage, which again is a very good complement to the residential space, but you're not living at a Home Depot or Lowe's anytime soon.
Right. Makes sense.
Real quick before we go into the company by company, I just want to emphasize why we're trying to get this message across is that we feel that real estate is personal. It doesn't matter if you may not care about Tesla, you may not care about Bitcoin, but Lord knows you care about the roof that's over your head when you go to sleep every single night. And so that's why we feel that this is a very personal connection, because every investor has to pay the mortgage payment, pay the rent payment. That check is due on the first of the month, and the landlord doesn't care that the gas prices are going up at the tank. He cares about, where's my rent that you owe me today?
Yep. That's exactly right. That's a very good way to look at that. Okay, let's jump in. I have actually the top 10 holdings right in front of me on the fact sheet for your fund. Tell me, though, if you want to jump into some specifically where you are really seeing some excellent potential at this time.
Sure. So we did talk about Mid-America, MAA, and Camden Property Trust, CPT. It seems like, for these guys that have been announcing earnings, and we're about to come up on first quarter earnings season here in the next couple of weeks. But for a lot of these guys, they're like, call it anywhere from 97 and 99% occupied. They're basically charging double-digit rent increases on renewals or on new leases. So what's happening is you're basically fully occupied, you're pushing double-digit rent increases, and yet you've got a line out the door of people that are ready to sign up. And that's really encouraging that, again, there's no let-up in sight for that demand. Camden got a lot of good press during COVID as they were very hands-on with their tenants. If you think about how many, there was a lot of tenant rent relief programs, TARP, that was put into place. And Camden was at the forefront, one of the first guys that basically put in this tenant relief program for their tenants because of COVID. And they carried a lot of favor with their tenants and the investment community because they weren't necessarily focused on the bottom line. They were focused more on their tenants' bottom line, if that makes sense.
Yeah, it does. I want to pause on that for just a second because I understand the point you're making is that, sure, you may take a short to medium term financial hit, but it seems, in a sense, brand building and having the value of a strong brand and a reliable company may translate into revenue and earnings growth. And I'm looking at the fundamentals of this company right now. I'm seeing how that happened, actually.
You make a great point. You know what? Hey, they stood by me while I was at, going through the problems a couple years ago. I'm not going to go find another landlord. These guys are for me. They took care of me. They're like family. And you're absolutely right. It's building that brand, that recognition. And their management team has been in place a long time. Their CEO, Rick Campo, is very well respected across the REIT industry. And so it's no surprise that that's, hearing what you're telling me.
Yeah, it does look like they had an earnings decrease in 2020, but then it bounced back again last year and then is forecast for double-digit increases this year and next year. So looking good. And this chart was very strong. I'm just looking at all of this. Yeah.
And I want to emphasize that for a lot of these companies, and it doesn't necessarily be residential. It could be any of these REIT sectors we're talking about here. But when most of these guys are announcing the results right now, they're comparing it to 2019. They're basically ignoring the 2020 ever happened. So they're saying, we're back to our 2019 pre-pandemic levels. We've surpassed our pre-pandemic levels, like American campus communities. There's only one student housing REIT that's out there, but that's a good example. American Campus, who's talking about their enrollment has surpassed where they were pre-pandemic. Their rent increases are getting back to where they were pre-pandemic, basically meaning students are going back to college. We're not sitting back, granted, the work from home situation might be here in some form or fashion, but students are not going to have to be learning virtual from a college classroom anymore. They're encouraging students to go back in. What's great about American Campus as an example, and I know they're not a top 10 holding, but what's a great story about American Campus, they're, picture your top Power 5 conference schools and everything, the big schools that are out there. If campus incorporates this square, they are the first property right across the street from campus. So it's technically off-campus housing, but it's so close to campus that you could almost like throw a football from the dorm into the campus. And it's luxury type dorms. The dorms that you and I probably grew up in when we went to school look like nothing like what we're seeing today.
Right. No, they were terrible. Yeah.
Go look at some of these properties today, and it's like some of the nicest apartment communities that are out there. So it's just a very unique story as another example of, where is this trend going?
And I'm seeing the exact same thing that we looked at on the last chart, David, with, you had that 2020 decline, and then boom, all the fundamentals are just roaring back in terms of this one.
The only one that again, I'm just speaking off the back of my head here, but the only ones that you're really going to see that big pop in 2020 were those two in single-family rental REITs, like Invitation Homes and American Homes for Rent. I bet you're going to see a strong 2020. Another one are the two there's three manufactured housing REITs. They're dominated by two in the industry, though, and it's Equity Lifestyles, ELS, and Sun Communities, SUI. These guys have been doing so well for a variety of reasons. Number one, retirees living in Palm Springs and some of these places. A typical manufactured housing property does not look like anything like what you used to think it looked like. Trailer park trash, that doesn't exist anymore.
Right.
My father lives in one in Huntington Beach, California, and it's a very, very nice home.
I think I know that area. I think I've driven past that on the 5 freeway there.
Yeah, there's a lot of these. They're very prevalent in Southern California. And so if you use, again, COVID as the example, well, what happened during COVID? Nobody was getting on a plane and flying. That was the year of the road trip. So many people were going out and renting RVs or getting in the family van and driving across the country and staying at some of these manufactured housing parks. What's really interesting with some of these guys is they've they've kind of had the aha light bulb moment where Sun Communities is a good example, merged with a company that focuses on marinas. So think about it. You have your RV, you're driving across the country. Chances are you may have a boat tied to the back of your RV. And so why not go stay at a property that has a marina right next door? And I could drop off my boat for a few days. We can go fishing and all that stuff. So basically, they're kind of combining the RV and marina business into one brand, let's say, to try to encourage folks of, hey, you're not just like plugging in here and hanging out for a couple of days. You're actually going to spend time here and live, work, play, fish, take the family boating, water skiing, whatever. And you'll notice that a lot of these, like especially in the Floridas and the Californias and the coasts, where they have this big presence.
It's interesting because there's a lot of different themes going on here. You've got families, you've got maybe young professionals, you got college students, you got retirees. But it seems like what kind of unifies all of this is this need for housing in a very specialized way that maybe nobody was thinking about 3 years ago.
That roof over your head, exactly. And we haven't even started talking about senior housing, and that's a whole separate beast in itself. From a very high level, there's a lot of good senior housing operators that are out there. Ventas, VTR, Welltower, WELL, they're the two largest players that are out there. They are in our portfolio, but they've also got exposure to like hospitals and medical office and stuff that may not necessarily be considered residential. But they are the largest senior housing operators by leaps and bounds. But let's high level this. Think about the senior housing property that mom or dad, grandma or grandpa live in today. Don't know when the last time was that you had to step foot in one of those properties, but chances are, if and when you did, you walked in and you said, I don't want to be in this place.
Nope, I'll tell you when it was. It was when my grandmother was in a skilled nursing care kind of place, and she passed away in 2006. So it's been a while.
Okay.
Yeah.
Sorry for your loss, but again, you'll understand where I'm coming from. Chances are that property has not changed in the 15, 16 years that she's passed to today. So why I use this example is think about, let's just throw it out there. Think about the 30-year-old young adult these days, okay? What is that young adult accustomed to? High-speed internet, flat-screen televisions, hardwood floors, modern amenities, upscale luxury living, USB ports. Yes, no, seriously. So think about that property that grandma lived in 15 years ago to what that 30-year-old consumer is going to need down the road. They're not the same. So we're talking about an industry, and this is why I feel like this story, our fund, is really a 25 to 50-year story, because this is a sector that is going to be turned upside down as far as revitalization, recapitalization, renovation. The property that you see today is going to look like a modern apartment community tomorrow, a modern residential neighborhood community, like a living community. It's going to be something different than just your typical 2-story nursing home. I don't know when that trigger gets pulled, but I do know that, I almost play like the Captain Obvious logic of there's no way that what we see today is what people are going to live in
right.
tomorrow.
And even the boomers, never mind the 30-year-old, I think even the 60-year-olds of today are accustomed to so much more and would not accept that.
So there's I'm not trying to cut you off, there was a fantastic story that got published today. Do you know what the Villages is?
Oh, in Florida, sure.
The Villages is the largest retirement community in the country by leaps and bounds. But what they've been talking about is the Villages is now considered one of the most dynamic cities in the country because baby boomers and younger are relocating to the Villages, and many companies are trying to plant their flag down there because the workforce has actually tended to go younger. So it may not be the 65-year-old that's first moving out there. It could be the 50-year-old, the young kid who is getting his foot in the door closer to retirement, but still wants to keep his foot in the corporate world. And so why don't we start working our way to Florida? Let's go move. We can go work day to day. And when we get old, then we can go across the street. My wife and I like to joke. There's an active senior living community that's like the largest in Dallas. That's like on the other side of our neighborhood here. It's my wife and I have this running joke of, when we're done, we'll just go across the street. It's right here. We can just walk our stuff right over. It's great.
Yeah.
But that's a perfect example here where if you think about, again, where senior housing is going and knowing that 50-year-olds are wanting to go to where the blue hairs are living at, not to be rude, but, that sends a message to a lot of corporate America that, wow, Florida's not just for old people anymore.
Oh, yeah.
So,
yeah.
One other point that I want to emphasize, and again, we're also doing this fund because we want to educate folks. Residential REITs may not be it for you, but we want to educate folks about the REITs in general, because you can't go from point A to point B without interacting with a REIT every single day of your life. In that, did you go to Starbucks and get a cup of coffee today? Did you go to the drugstore and go fill a prescription? What about going to the grocery store? Did the grocery store in the past couple of days? Chances are those properties are all owned by REITs. And so we're just trying to take this approach of embrace it. You can't run away from it. And when you think about how the REITs are structured themselves, remember, REITs are investment vehicles that produce revenue from the properties that they own, and they turn around and pay 90+% of that taxable income to shareholders in the form of dividends.
Yeah, we didn't even get into that, but I agree. That's very compelling.
I mean, again, it doesn't matter how old you are, but when the company is basically paying you the money that they earn, and the management teams themselves own so much stock of these companies, again, because of the dividend structure, everybody benefits from this. When the company does well, earnings goes up, dividends go up. Guess what? Management got a nice bonus because of the shares that they own, and the shareholders are doing well because the company is doing what they're supposed to be doing. Meaning, look at COVID as the example. Net lease REITs. These are the properties that own the drugstores, the fast food restaurants, the Starbucks, the Dunkin' Donuts. Those guys were on fire during COVID. Think about curbside pickup and how great that was doing. Those companies were getting literally like 100% of their monthly rent. They weren't having any issues because, again, people were driving to, go to drive through the Starbucks every day. So we're just trying to educate folks that REITs are here to stay. The industry is going to continue to grow. And so as a result, embrace it.
Hey, I've thought this has been a great education. I have super enjoyed this conversation and learned a lot. If the listeners want to know more about Armada and about your ETF, how can they find you, David?
Sure, that'd be great. Please check out ArmadaETFs.com. We have all sorts of information. If you want to learn more about the REITs in general, I recommend you go to the website's REIT.com, REIT.com. That's the National Association of Real Estate Investment Trusts. Great education materials there, but we're always around to chat. So feel free to contact me. My contact info is on the Armada ETF website.
All right. Thanks again, David. Really appreciate your time today.
Thank you so much, Kate. I really appreciate it.
All right. That's a wrap on this week's episode. Thank you so much for listening. Don't forget to subscribe so you don't miss a single episode. You'll find the show on all your favorite podcast apps, Spotify, Stitcher, Google, Apple Podcasts, of course, anywhere else you get your podcasts. And you can always find us on MarketBeat.com. And please, if you're enjoying the timely market insights we're bringing you each week and finding them valuable, please give the show a 5-star rating on Apple Podcasts. That will help others find the show so we can bring these investing ideas to an even wider audience.